Imagine you're a retail investor checking your brokerage account, watching your stocks go up and down, feeling smart when you pick a winner and frustrated when you pick a loser, and you're operating under the assumption that you're playing the same game as the big institutional investors, just with less money. But here's the uncomfortable truth that nobody in the financial industry wants you to understand. You're not playing the same game at all. BlackRock, the world's largest asset manager, controlling over $10 trillion, operates in a completely different reality than retail investors. They have access to information you'll never see. They use analytical tools you can't afford. They have relationships with company executives you'll never meet. They can move markets with their decisions while your trades are statistical noise. And most importantly, they understand something fundamental about modern finance that retail investors almost never grasp, which is that the stock market isn't primarily about picking good companies anymore. It's about understanding flows of capital, positioning ahead of structural shifts, and exploiting informational and operational advantages that compound over time. And once you understand what BlackRock knows, once you see how institutional investors actually operate, you realize that the entire narrative sold to retail investors about stock picking, about doing your research, about finding undervalued companies, this is mostly mythology. It's not that these things don't matter at all, but they matter far less than the structural advantages that large institutions have, advantages that are so significant that they essentially make it a different game. And understanding these advantages doesn't mean retail investors can't make money in markets, but it does mean they need to completely rethink their approach. Because trying to beat BlackRock at their own game is like trying to beat a chess grandmaster when they can see the whole board and you can only see your own pieces. It's not impossible, but the odds are so stacked against you that a different strategy is required. Let's start with information asymmetry, because this is perhaps the most obvious but least understood advantage that BlackRock and similar institutions have. And I'm not talking about illegal insider trading. I'm talking about completely legal informational advantages that come from scale, relationships, and resources. BlackRock manages money for thousands of institutional clients, including pension funds, sovereign wealth funds, and corporations. And through these relationships, they get access to information flows that retail investors never see. They know what pension funds are planning to buy or sell. They know what corporations are thinking about their capital allocation. They know what sovereign wealth funds are concerned about. And this isn't specific trading information. It's context. It's understanding the bigger picture of where capital is flowing and why. And this contextual information is incredibly valuable because markets are ultimately about supply and demand for capital. And if you know where the big pools of capital are moving before they move, you have an enormous edge. Retail investors, by contrast, are reading public news, analyst reports, and social media, information that's available to everyone and therefore already priced into markets by the time you see it. So retail investors are always operating on old information while institutions are operating on fresh flows. The analytical capabilities that BlackRock possesses are also on a completely different level. They employ thousands of analysts, data scientists, and quantitative researchers. They have proprietary technology platforms like Aladdin that process millions of data points in real time, analyzing risk, correlation, and opportunity across global markets. And this isn't just about having more people or better computers. It's about having systems that can identify patterns and relationships that are invisible to individual investors. For example, BlackRock can analyze how changes in commodity prices, currency movements, interest rate expectations, and corporate earnings are all interconnected across thousands of securities simultaneously, and they can position their portfolios to benefit from these complex relationships. While a retail investor is looking at whether a single company's earnings beat expectations, which is like analyzing one tree, while BlackRock is analyzing the entire forest ecosystem. And this difference in analytical scale and sophistication means that institutional investors are playing a fundamentally different game. They're not trying to pick individual stocks that will outperform. They're trying to position entire portfolios to capture systematic factors and structural trends that they've identified through massive data analysis. The access to company management is another huge advantage that people underestimate. When BlackRock wants to talk to a CEO or CFO, they get a meeting. They're not just attending earnings calls like retail investors. They're having private conversations where they can ask specific questions, understand management's thinking, and sometimes even influence corporate decisions. And while regulations prevent companies from sharing material non-public information in these meetings, there's still enormous value in understanding tone, emphasis, and context that doesn't come through in public communications. BlackRock can ask follow-up questions, can probe on specific issues, can understand the nuances of management strategy in ways that aren't possible from reading SEC filings or watching earnings call transcripts, and over hundreds of these conversations across their portfolio. BlackRock builds a much richer understanding of corporate America than any retail investor could possibly develop, and this access isn't just about information, it's about influence. When BlackRock talks, companies listen because BlackRock's ownership stake and proxy voting power give them real influence over corporate governance. So they're not just passive investors trying to predict what companies will do. They're active participants who can sometimes shape what companies do. The structural advantage of size is often misunderstood. People think that being too big is a disadvantage in markets, and in some ways it is. BlackRock can't easily buy small caps or make quick tactical moves because their size limits their flexibility, but size also provides massive advantages that more than compensate. First, size provides economies of scale in research, technology, and operations. BlackRock can spread the cost of their analytical infrastructure across trillions of dollars, making it incredibly efficient, while retail investors pay the same costs whether they have a $1,000 portfolio or $1 million portfolio. Second, size provides negotiating power. BlackRock pays tiny fractions of a basis point in trading costs while retail investors, even with zero commission trading, face much higher effective costs through bid-ask spreads and market impact. Third, size provides access to investment opportunities that retail investors simply can't access: private equity, infrastructure projects, direct lending. These asset classes are only available to large institutions, and they often provide better risk-adjusted returns than public markets. And fourth, size provides staying power. BlackRock can weather market crashes, can wait out periods of underperformance, can take long-term positions without worrying about redemptions. While retail investors often panic and sell at exactly the wrong time because they don't have the same resources or time horizon. One of the most important things BlackRock understands that retail investors don't is the importance of factor exposure over individual stock selection. Modern finance research has shown that the vast majority of portfolio returns come not from picking specific stocks, but from exposure to systematic factors like value, momentum, quality, and size. And BlackRock's portfolios are constructed to capture these factor premiums efficiently. They're not trying to find the next Amazon, they're trying to systematically harvest risk premiums that have been shown to exist across decades and across markets. And they do this through sophisticated portfolio construction that balances factor exposures, manages risk, and minimizes costs. While retail investors are often trying to pick individual stocks based on stories or tips, or their own analysis of company fundamentals, which is much harder and much less reliable than capturing systematic factor premiums. And this difference in approach, systematic factor harvesting versus individual stock picking, explains a lot of the performance gap between institutional and retail investors. Because factor premiums are real and persistent, while stock picking skill is rare and inconsistent. BlackRock also understands the power of passive investing and indexing in ways that retail investors often misunderstand. BlackRock is the largest provider of index funds through their iShares brand. And while retail investors often think of index funds as just a simple buy-and-hold strategy, BlackRock understands that running index funds at massive scale provides several hidden advantages. First, index funds receive all the flows from investors who are systematically investing regardless of market conditions, retirement contributions, institutional rebalancing, and this provides predictable demand that can be exploited. Second, index funds have to buy stocks that enter an index and sell stocks that leave, and BlackRock knows this and can position ahead of these forced flows. Third, index fund holdings create voting power that BlackRock can use to influence corporate governance across the entire market, effectively giving them a say in how most large companies are run. And fourth, the fee income from trillions in index fund assets provides the resources to invest in technology, research, and capabilities that create competitive advantages in other areas. So index funds aren't just a product BlackRock offers. They're a strategic position that creates multiple layers of advantage. The importance of understanding market structure is something BlackRock grasps deeply while retail investors barely think about. Markets aren't natural phenomena. They're constructed systems with rules, participants, and mechanics. And understanding how these systems work provides advantages. BlackRock understands how different types of traders interact, how market makers operate, how liquidity varies across different times and conditions, how various derivatives and structured products affect underlying markets, and they can use this understanding to optimize execution, to identify opportunities that arise from structural inefficiencies, and to avoid pitfalls that trap uninformed investors. For example, BlackRock understands that markets often gap at the open or close, that volatility follows predictable patterns, that certain market participants have to trade at certain times regardless of price, and they can position to take advantage of these structural features, while retail investors are often unaware these dynamics exist and trade randomly throughout the day without understanding how market structure affects their outcomes. Risk management is another area where the gap between BlackRock and retail investors is enormous. Retail investors often think about risk as this stock might go down, but BlackRock thinks about risk in sophisticated multidimensional ways. They measure correlation risk, tail risk, liquidity risk, counterparty risk, and dozens of other risk factors, and they construct portfolios to manage these risks systematically. They use stress testing to understand how portfolios would perform in various scenarios. They use derivatives to hedge specific risks, and they maintain risk budgets that allocate risk exposure strategically across the portfolio. And this sophisticated risk management means that BlackRock can take positions that would be too risky for retail investors because they're managing the risk systematically. While retail investors often either take too much risk because they don't understand it or take too little risk because they're overly fearful, and neither approach is optimal, whereas BlackRock's systematic risk management allows them to optimize the risk-return trade-off in ways retail investors simply can't match. The time horizon difference is crucial and often overlooked. BlackRock manages money for institutions with very long time horizons, pension funds that need to pay retirees decades from now, sovereign wealth funds that are thinking generationally. And this allows BlackRock to take long-term positions, to invest in liquid assets, to weather short-term volatility, and to position for structural trends that might take years to play out. Retail investors, by contrast, often have much shorter time horizons. They need money for retirement in 5 or 10 years, or they're trading to generate income, or they're influenced by short-term market movements and news. And this difference in time horizon creates completely different optimal strategies. What makes sense for a 30-year institutional portfolio doesn't make sense for a 5-year retail portfolio. But retail investors often try to copy institutional strategies without understanding this fundamental difference in time horizon. BlackRock also understands the importance of asset allocation far better than most retail investors. Academic research shows that asset allocation, deciding how much to put in stocks versus bonds versus alternatives, explains over 90% of portfolio returns over time, while security selection, picking individual stocks or bonds, explains less than 10%. But retail investors spend 90% of their time on security selection and barely think about asset allocation. They'll agonize over whether to buy Apple or Microsoft, but won't think carefully about whether they should have 60% or 80% in stocks at all. Whereas BlackRock spends enormous resources on strategic asset allocation, on understanding how different asset classes interact, on positioning for macroeconomic scenarios, and on adjusting allocation as conditions change. And this focus on asset allocation over security selection is one reason why institutional portfolios often outperform retail portfolios, even when the individual security selections aren't that different. The tax efficiency that BlackRock achieves through various strategies is also something retail investors often miss. BlackRock manages money in ways that minimize tax drag, using tax loss harvesting systematically, locating assets in tax-advantaged accounts appropriately, using structures like ETFs that are more tax-efficient than mutual funds, and employing strategies that defer or minimize capital gains. And over decades, these tax efficiencies compound into significant outperformance, while retail investors often trade without considering tax implications, triggering unnecessary capital gains and reducing after-tax returns. And this is particularly important in the United States, where capital gains taxes can significantly reduce investment returns. So too, portfolios with identical pre-tax returns can have very different after-tax returns based on how tax efficiently they're managed. BlackRock also benefits from regulatory capture and political influence in ways that shape the financial system to their advantage. They consult with regulators, they influence policy debates, they have alumni in key government positions. And while this isn't corruption in the traditional sense, it does mean that regulations and policies often benefit large asset managers, either explicitly or as unintended consequences. For example, regulations that require institutions to use sophisticated risk management systems create business for BlackRock's Aladdin platform. Regulations that push investing into passive vehicles benefit BlackRock's index funds. And post-2008 reforms that increased capital requirements for banks have pushed more financial activity into asset managers like BlackRock. So the regulatory environment is partly shaped by and for large institutional investors, creating structural advantages that compound over time. The network effects in institutional investing are powerful and underappreciated. BlackRock's relationships with other large investors, with company management, with service providers, with policymakers, create a self-reinforcing ecosystem where information flows, deals get done, and opportunities arise that are simply unavailable outside this network. If you're not in the club, you don't even know what opportunities you're missing, and retail investors are by definition outside this network. They're not getting calls about private placements. They're not being offered co-investment opportunities. They're not having conversations that shape industry direction. And this network exclusion means that even if retail investors had the same analytical capabilities and resources as BlackRock, they still wouldn't have access to the same opportunity set. So what does all this mean for retail investors? Because understanding that you're playing a different game doesn't mean you can't play at all. It means you need a different strategy. First, stop trying to pick individual stocks unless you have genuine edge, which almost no retail investors do. The evidence is overwhelming that active stock picking by retail investors underperforms. Second, embrace diversification and low-cost index investing, which is actually the one area where retail investors can compete because index funds are available to everyone at similar costs. Third, focus on things you can control: asset allocation, costs, tax efficiency, and behavioral discipline. These matter much more than security selection. Fourth, if you do want to pick stocks, focus on areas where institutional investors have disadvantages, like small caps or special situations where your small size is actually an advantage. Fifth, extend your time horizon as much as possible, because this reduces the importance of short-term information advantages that institutions have. Sixth, understand that your edge as retail investor, if you have one, comes from different sources than institutional edge. Maybe it's industry knowledge from your career. Maybe it's patience to hold through volatility that causes institutional redemptions. Maybe it's willingness to invest in unfashionable areas that institutions avoid. But whatever your edge is, it's not going to be competing directly with BlackRock's analytical resources or informational access. The uncomfortable reality is that modern financial markets are increasingly dominated by large institutional investors who have compounding advantages in information, analysis, access, scale, and network effects. And the gap between institutional and retail investors is widening, not narrowing, despite rhetoric about democratization of investing. And this doesn't mean markets are rigged or that retail investors can't succeed, but it does mean that retail investors need to understand the game they're actually playing, which is fundamentally different from the game institutions play. And success for retail investors comes not from trying to beat institutions at their own game, but from playing a different game where their unique advantages, like flexibility, patience, and niche knowledge, can actually matter, and from avoiding the traps that institutions set, like overhyped IPOs, crowded trades, and expensive active funds that claim to offer institutional quality management, but actually just charge high fees for mediocre performance. And perhaps most importantly, retail investors need to understand that the financial industry is not designed to help them succeed. It's designed to extract fees from them. And everything from broker recommendations to financial media to product design is optimized for generating revenue for financial firms, not for generating returns for retail investors. And the sooner retail investors understand this, the sooner they can make decisions that actually serve their interests rather than the interests of the financial industry. And this is what BlackRock knows that retail investors don't. Not some secret trading strategy or hidden information, but the fundamental structure of modern markets, the nature of informational and operational advantages, and the reality that investing isn't a level playing field and never will be. And that success comes from understanding your actual position in this structure and acting accordingly, not from pretending you're playing the same game as the giants who increasingly dominate global finance.